Anyone can invest in stocks. If you're just a beginner or you don't know where to start, in this video, I'm going to show you a way how you could actually get started with just $3,000 and own some of the best companies in the world with this simple ETF portfolio strategy. So before I get started, thank you everyone for giving me a bit of time to check out this video. If you're not part of my small, humble community yet, do click on that small red subscribe button below so that you never miss an episode. And no mum, you don't have to pay to subscribe. So since I started this YouTube thing, I had a few colleagues and friends ask about actually how to get started in investing. So I thought now is a good opportunity to actually make a video about how someone can actually go about building a very simple beginner stock portfolio with just $3,000, investing in easy stocks that enable you to own some of the best companies in the US like Amazon, Apple, Netflix, and Alphabet. Also owning stock in Singapore where you can own DBS and Singtel and companies like CapitaLand, and also invest in another stock that actually enables you to own really great stocks in Australia like BHP, Commonwealth Bank, and CSL. These are the three markets that I personally do my own stock investing in, and I personally love each of these different companies for different reasons, which is why I've actually centered my beginner's portfolio around these three countries. So with this beginner stock portfolio, you could actually generate just over $100 a year in passive income for the rest of your life. And what you would actually do is start adding to this portfolio when you get more cash. And as you do, that dividend and that passive income would basically grow and grow every time you do that as well. So what I'm going to do in this video is A, go over what an ETF is, B, go through 3 ETFs that I would invest $1,000 each in, and C, the benefits of owning each of these ETFs at the same time as well. So hopefully making this video, I'll be able to inspire some beginners to actually jump in and get started and rather not spend their money on a designer handbag like one of my colleagues suggested she could do instead of getting started in investing. So let's go. So what is an ETF? An ETF is short for an exchange traded fund. It's an investment that basically commonly tracks the performance of an underlying index. That index, for example, could actually represent an entire stock market of a single country, for example. So an investor can actually buy one share in a single ETF and actually indirectly own a whole group of different companies that actually make up that country's index. And hence, you actually don't have to worry about picking individual stocks and picking the best companies to actually invest in. It's a simple, lazy way to actually start investing in a group of diversified companies with just one purchase of one stock. So the first ETF I would start with is the Vanguard S&P 500 ETF, ticker symbol VOO. So Vanguard is one of the world's largest providers of low-cost ETFs. Low cost meaning that their fees for buying the basket of shares on your behalf and managing them is really low, which actually over the long term does actually make a big difference in terms of your overall investment returns. So this ETF invests in stocks in the S&P 500 index. So buying this ETF essentially means you're buying a share in 500 of the largest US companies. Now this index has actually returned a historical annualized average return of around 10% per annum since its inception back in 1926. And the US obviously holds some of the greatest growth companies that are actually really defining our generation at the moment. So getting exposure to the US is important for long-term sustainable growth, which is why I would start with this ETF in my portfolio. Now the stock currently trades at just over $306. It's currently yielding at just 1.66%, but you're really not investing in this stock for yield, especially if you're in Singapore and Australia as well, because you're subjected to obviously a lot of withholding taxes on the dividends, but you're really buying this ETF for growth and not dividends. And this stock has a very low expensive ratio of just 0.03%. The 10 largest stocks this ETF owns are Apple, Microsoft, Amazon, Alphabet, Facebook, Berkshire Hathaway, Johnson & Johnson, Visa, P&G, and Nvidia. So just buying this one stock of this ETF, you can actually own a tiny bit of these awesome companies. And I don't know about you, but I would actually be happy owning these companies for the rest of my life. So the second ETF I would add to my beginner's portfolio is another Vanguard ETF, and it's Vanguard's Australian Shares Index ETF, ticker symbol VAS. Now this ETF actually seeks to track the return of the S&P ASX 300 index, which is actually designed to provide investors with broad exposure to the Australian equity market and actually tracks the top 300 Australian companies by market capitalization. So this index in my hometown in Australia has returned an annualized average return of around 7.75% over the last 10 years. So Australia was actually the only major economy to avoid a recession during the 2008 GFC, and that was rationally mainly due to China and its demand for our natural resources. And only recently did Australia experience its first recession in nearly 30 years due to this pandemic that's happening at the moment. But just like the rest of the world, it's something that Australia's had to go through. So history obviously can't predict the future, but the Australian economy has actually been relatively steady, and a large portion of the Australian stock market are actually made up of big dividend-paying companies. So the stock is currently trading at just over $73, and it's currently yielding at just under 4.5%. And it has really low expense ratio of just 0.1% for fees. So Australian companies also provide franking credits on some of their dividends, which actually allows for tax credits for Australian investors, and actually means no withholding tax on the franked portion of any dividend for Singapore-based investors. So it's actually a great pay for Singaporeans to diversify outside of Singapore and get no withholding tax on the dividends that are actually paid. The dividend yield is actually a nice way to generate some income for a beginner investor, and you'll be able to actually see the dividend payments coming into your brokerage account a couple times a year. So once you actually get a few, I assure you, you're actually going to be quite hooked, and you'll actually want to invest more to actually get paid more profits from these companies each time that they've paid these dividends as well. And this really helps you understand that by investing, your money's making money for you. So this ETF holds CSL, Commonwealth Bank of Australia, BHP, Westpac, National Australia Bank, and ANZ Bank, and also owns supermarkets such as Woolworths and Wesfarmers, and they all pay a nice juicy dividend which this ETF then pays out to its shareholders. Now the last stock I would add to my beginner stock portfolio is the Spider Straits Times Index ETF, which is Australia's first locally created exchange traded fund and is actually designed to track the performance of the Straits Times Index. So the Straits Times Index is the globally recognized benchmark index for Singapore essentially, and its history dating back to 1966, where it actually tracks the performance of the top 30 listed companies on the Singapore Exchange. The index since 2002 has actually returned an average annualized return of 5.5% a year. So the stock currently trades at just over $2.50 and has a yield of 4.5% and an expense ratio of 0.3%. So in terms of sector weightage, this ETF actually is made up mostly of banks, which makes up 60%, and industrials as well as telecommunications. So some of the holdings that this ETF owns are some of the big banks that you guys all know would be DBS, OCBC, UOB. It also owns things like Singtel and StarHub, as well as developers and REITs such as Ascenders REIT, as well as CapitaLand and Keppel Corp. So looking through this list, many of these companies are actually household names here in Singapore, and we see around the island every day and regularly used. And there's that kind of sense of familiarity, which is, I think, actually great for beginner investors. Now, I reckon Singapore is the best country in Asia and is really seen as the bridge between the Western world and Asia itself. And, why wouldn't you want some exposure to its economy? So that's the 3 ETFs that I would actually start with my beginner's portfolio. So I would invest $1,000 in each ETF to actually start this easy set and forget share portfolio that you could actually regularly invest in, say every couple months when you have some spare cash, through a technique people call the dollar cost averaging, which is basically buying stocks at regular intervals, whether it's a month or 2 months or 3 months apart, the same amount of money each time. If the stock is a little bit more expensive at that time, you buy a little bit less. If the stock is cheaper, that sum of money buys you a little bit more. So ETFs are an easy way to get diversification to some of the biggest companies across different countries, and it's a much lower risk way to actually start investing in stocks rather than to actually having to choose individual companies to invest in. So it's a great place to start for beginners to actually get used to holding a stock before jumping into individual company stocks. So I hope that gives anyone thinking of getting started in investing in stocks and an idea of actually how to start. So that's it, guys. As always, if you liked this video, hit that like button, and if you learned anything new or just enjoyed watching this video, please subscribe to my channel to join my humble little community. And until next time, see you guys.